Happy Friday, everyone. Jason Jacoby and Mark Boyer here with your closing bell for March 1st. We're here, the end of the first quarter. Earnings season's pretty much over. It's been a good earnings season. Mark, it's pretty crazy, isn't it? It's been a heck of a start to the year, wouldn't you say?
Yeah. It's kind of that old saying, how the beginning of January goes, so goes the market, especially early on. So we've had a big run here. So um, interesting today, the NASDAQ actually, we've talked about this in the past. So just real quick, maybe it's good to share this, but today, the market hasn't closed as of this
Recording.
call yet, but let me just show you the NASDAQ. The NASDAQ is the one we've been waiting for to see if it would, eventually get to that place where it breaks out and gets to new highs. The Dow, we talked about the Dow, the S&P has hit new highs over the last few weeks, and the NASDAQ, was it last week or the week before? I think I said, hey, there's going to be a
Yep.
natural tendency for that NASDAQ to head to its highs. And here's the chart. If you're viewing this podcast, you'll see going back here, we had a high back in 2021, late 2021 of 16,212. And so this is a weekly chart. And, the last couple, and then way over here to the right is currently the last couple, 2-3 weeks, we were kind of getting closer. And then we see here that it's actually broke out this week. Let me go to now, just showing you kind of that other chart. But here's the breakout today. We're up a couple hundred points on the NASDAQ again, and we still got we still got time to go here on this Friday, March 1st. Can you believe it's March 1st, by the way? It's crazy. But yeah, so anyway, that's interesting, and then I think the other, it's been talked about, it's a run of the, the Magnificent Seven or whatever, the kind of these stocks that have been, kind of running that whole show. And, we're getting a little bit, I was looking at some equal weighted indexes. Here's the NASDAQ equal weight. First Trust has the same thing. So equal weighted trust of the top 100 and an equal weighted basis. We're still also getting, you see here, we're breaking out to new highs there. So that's a good sign. It's not just the Mag 7, but there's a lot of other stocks that are moving in here. So anyway, that's, good news. So what does that mean? Sell, run for the hills. We're at a top and it's all going down from here. You never know, right? You don't know that. But at the same time, typically when you break into new highs, there's a real chance we see it continue here for a while because you have no more resistance. So sellers kind of been burnt. If they've sold at the top, now that it's moving forward, you get this fear of missing out, FOMO, and it can continue to run, especially with where interest rates are right now and so forth. So yeah, all to say is, probably wise to be keeping an eye on things, if you're a trader, but if you're an investor, just enjoy the ride for now. So anyway, I think it's we'll see what continues to go on.
Good points. And, just so we get a quick recap of the week so far, we've got Dow Jones, pretty much trading flat this week, down 0.16 at the time of recording on Friday morning. Excuse me. The S&P 500 up about 0.89%, and the NASDAQ, you think it'd be leading the way. It's not. Small caps leading the way this week, 2.9%, almost 3% for the week. Pairing off of the NASDAQ, which is up almost 2% for the week.
Look at the Russell today. It's breaking. It's really been moving up here. And today we're not breaking out. We still got a long way to go to get to highs on the Russell 2000. Small caps have not participated at all, like the other larger caps. But a lot of that has to do with that banking crisis we had last year, and just kind of a lot of these stocks in the Russell don't make money. So anyway, all that said is that it's good to at least see the small caps participating for sure.
And I think it is because of what we're going to talk about today, the PCE versus CPI numbers. We had the personal consumption expenditure report from the Commerce Department actually come out this week, which is actually what we want to focus on. But I think that is why small caps are actually having a great week, because it's showing that inflation actually, based off of the latest report, is trending in the right direction, sub 3 numbers. So, and that's actually the report that the Fed actually looks at when they're looking at cutting or raising interest rates. So thus small caps go coming out of an economic slowdown, out of high interest rate environment, which obviously hurts small American companies. this could be a nice springboard for the Russell 2000, but mostly the profitable or trying to be profitable small cap space. So this will be a good segue. All right, everyone. So we have two numbers we look at, right? We look at the PCE versus the CPI report. And the Wall Street Journal actually had a great article on it this week. So we really want to decipher what these are about. Mark's actually does some awesome research, which we'll get into just off of housing prices, which we'll get to in a second, which I think you'll find very interesting if you've tried to buy a house recently, or if you have, or if you're going to soon, right? So, Mark, one says 2.4% and another says 3.1. PCE says 2.4. CPI, which is the Labor Department's version, says 3.1. So which one is right? Before you answer that question, let's talk about the differences.
I don't know if either one of them is right, honestly. It feels.
I know, right? There's a lot. I think there's a lot more hidden numbers in the pudding, to use a food analogy there, right? We all feel that in our pockets in the grocery store, but I think it's important to talk about the differences of the two.
Yeah.
So
Yeah.
CPI is actually done again by the Labor Department, and that's a monthly report on the consumer prices. And that's generally thought of as the inflation report. You know, it generates headlines, it features in politicians' speeches, and moves markets. And then obviously that report that came out earlier this month showed a hotter than expected report, and that sent the Dow Jones actually tumbling more than 500 points. So, but you know, the Labor Department's figures aren't the Fed's focus actually. Instead, they focus and they base their 2% inflation target on the data that comes out of the Commerce Department's version, which is the PCE numbers that we saw this week. So, Labor Department, CPI, based off of household surveys on an annual basis. That's what the consumer says they're spending money on, right? And it's actually shown that they actually kind of fudge their numbers a little bit. They lie. So numbers actually show, Mark, that consumers say they spend half of what they actually spend on alcohol. So they spend double the amount on alcohol than they actually say, if you actually look at the numbers, which is interesting, right? So that just shows you that things actually are kind of off, and it's about what they say in that report rather than actual spending numbers, which is what the Commerce Department, the PCE numbers, are based off of. So is actual spending. Yeah. And for the cost of goods and services. So I thought that was kind of interesting.
Yeah, and the article talked about Alan Greenspan. Somehow, back 20 years ago, they kind of made a decision that they wanted to go with the PCE and versus the CPI. Anyway, there's a lot there. It's a great article. You guys could read it. But I don't know, Jason, when I think that it feels like lately the CPI, is that's the number they go off of, or the CPI is what we all are seeing, and what the Feds go off is the PCE, which happens to be PCE, personal consumption expenditures, being lower. It's a little softer, and so does it make it look better? I mean, it looks better, right? I mean, in the sense right now, and the gap actually, as the article is never been wider right now. Is how those two numbers, the comparison, it's usually tighter than this. And so, the question is, CPI is still pretty high, not close to the 2%, where PCA is better, and so they're Fed's kind of saying, hey, anyway, yeah. So all that to say is like, I don't want them to necessarily raise rates anymore, or and go off PC, but it's just interesting to see what's happening here. An interesting that I found when I read that article, and I think about the difference between the two, is housing, rents, things like that represent 34% of the CPI. So if you have a higher number in the CPI, could be because it's 34% of that index, versus in the PCA that the Fed's using, it's only 15%.
There you go.
Those are shelter costs, normally, like rents, things like that. So you have a much bigger, and I know for most people that are listening to this podcast, they're seeing the prices in that area. Is an area that they see there. For me, I'm watching my kids and just dealing with trying to buy a house nowadays, whatever, is not so easy, right?
Yeah.
And then the other, it just makes it tougher. And so it feels a lot heavier than I think what the PCE is saying and for the normal consumer out there. So
Yeah.
it's really interesting. And anymore, man, I don't even know, like, the government yeah. And you said they're lying, are they using the numbers to their advantage? I don't know. It feels a lot heavier than what they're saying, I think, for most people.
Yeah, and I think that's a good point you brought up. The discrepancy, the weighting of the housing sector, shelter costs, and the discrepancy of those PCE and CPI numbers, and the overall weights of each of those, housing in those, could be a portion of why there's such a big, delta, a big difference. Again, largest in 60 years. So,
Yeah.
why don't you
Well,
talk about?
but also PC, though, don't another thing to remember is that it also excludes food and energy.
Mhm.
Okay, so housing costs are less of it, and then also it excludes food and energy. Um,
And the
thus,
core number?
again,
Yeah,
yeah, the core number, that again. So thus, I mean,
true.
you throw out food and energy, and then your housing component is less in it, right? I mean, it just
Right.
seems like, all right, well, so is that really accurate? I mean, I went to Costco the other day. I feel like it's just me and my Shannon at home. It's just my wife and I, but we got family, a lot of grandkids and stuff. But it's just like, wow, food prices right? I
Yeah.
mean, you're a
Yeah.
father of two with another
Oh,
one.
yeah.
Holy smokes. I mean, it's really expensive. And fortunately, like, you just throw that number, that's not a part of the number. I mean, come on. I mean, that's what people are spending money on. And then energy, right? The cost of,
100%.
you stop drilling, prices go up. We don't count those. I know. Anyway, it's just
Right.
like, seems sort of. I mean, okay, the number looks great, but it's like, really. I
Yeah.
mean, it seems sort of. You know, it helps you on a personal basis if you're just measuring those numbers. So anyway, crazy.
Why don't you share the data that you did some research on this morning, just in terms of housing, right? Because obviously housing's been a big talk.
Yeah,
Housing prices have actually been pretty stable in terms of, because the supply is so low, right? It's not
yeah,
because rates went up, you'd expect prices to drop a ton, but inventory's been so low that prices haven't come down as much as a potential home buyer would like. So why don't you share what you found from 1985?
yeah. And this has. I mean, it's not. It's a little bit off of the CPI PC. But it kind of, I think it actually is also, though, a part of it too. And this came from a conversation my wife and I have been having lately. It's just in regards to how hard it is today versus for younger people to buy single family homes. Now we live in Orange County, California, one of the it's probably, California being as a whole, the highest home prices in the country,
Hmm.
um, and have been for a while. The weather's great. There's a lot of people moving from here, but still, I don't know. I mean, everybody talks about. I know lots of people that have moved, but somebody's bought their house, so I don't know.
Right. Right. Yeah.
And that's part of this question here. But interesting. So and I just use these numbers because it's when my wife and I bought our first house, when I was a rookie in the NFL, and got a little signing bonus, $20,000, which to us was a ton of money back in the day. But I looked at some numbers just on a national basis of average income back in 1985. Okay, so it's roughly 38 years ago. The average income was 23,600. Okay, or for a family, a household family. Okay, 23,600. And at the same time, the average home, okay, remember, interest rates were much higher in the late 70s, 80s. In my first home in 1985, I got a 12.5% interest. Okay. And I thought that was a deal. Like, think about it. Like, dude,
Yeah.
12.5%, that's a deal. Um, but the average home at that time was worth 84,000. Okay. So 80, income 23.6, average home 84,000. Let's fast forward to 2023, 38 years later. Average income $59,400 on average. This is national, okay? 59,000 a year. Average home $759,000 average home, okay? That's basically, so back in 85, a home cost about 3 times much. An average home costs about as 3 times more than an average salary. And in 2023, it's almost 13 times. Okay. So that's crazy. So wages, I ran some numbers on wages. So wage inflation along that way. So wages have increased year over year for 38 years based on those numbers, 2.46%. At the same time, housing has increased 5.96%.
Mm,
Okay.
mm,
More than double. All
yeah.
right. If we turned it around and invested the money, just to give you perspective on that, if you had 100,000 in 1985 and invested it at the inflation rate of wages, today you would have $252,000. 100,000 now today 252. If you did the same thing at the housing number, $100,000 at housing in 1985, today at 5 point almost 6%, 5.96, you would have $902,000. Okay, so 252,000 invested versus 900. That's a big difference, and that gives you the scope of how housing has gone up significantly in that time. You and I asked the question, why is that? You asked, so why did that happen? Well, that'd be another whole podcast and something. But why is housing so much more expensive for the average home buyer today than it was then? Well, a couple ideas. One is, at that time we saw a 40-year reign basically of interest rates coming down. So as interest rates came down from 85, like interest rates kept coming down 12.5%. They came down. People were, refinancing, taking money out, refinancing all the way down to what? I mean, all the way down to 2005, 2007, actually 2000, it was just a long, consistent period of time,
Yeah.
really up until actually just a couple of years ago, 40 years. It was basically 40 years of declining interest rates. So it's
Yep.
very beneficial for housing, right? Very
Yep.
beneficial. And then now we've got, rates are, and then '08 happened and, then they forced interest rates down, financial crisis, all these different things. So could be that maybe because of the lower interest rates over that period of time that the value of homes, because you could afford more, because you could borrow more at lower
Yeah.
payments, lower
Yeah.
interest rates was probably a positive, right?
Absolutely.
That could be one thing. Another thing I thought of is that I know it's been about 20 years now. It seems like, and really around '07, '08 in that era too. But even before then, you were getting a lot of, you know, Blackstone, different companies were actually starting to buy homes, single family homes. They used to just dwell in apartment buildings, and then I think it really exploded in the financial crisis because homes were going for foreclosures like crazy, and a lot
Yeah.
of private equity, institutional, companies came in and actually using investors' money started buying rental properties in areas that are actually used to be where young families would grow and get homes too. So that could be part of it. I saw an estimate on that. It's like 22%. I read an article. 22% of America homes were owned by corporations or professional, or institutional ownership in 2022, which I don't believe 38 years ago there was much of any of that happening in the single family home market. So that could be another issue there. But that's again, all these things said, I think bite into the fact that it feels like inflation is a lot higher. It's a lot more. It's a lot heavier on consumers today
Right.
than it even feels like the Fed is talking about. I mean, you're a young guy. Do you agree?
Absolutely. I agree 100%. Yeah.
Yeah.
It's I mean it's crazy how much money you have to make to just the data even shows. I think it's, don't quote me exactly, but there was a news article, maybe it was Wall Street Journal as well, talking about a majority of Americans making 150,000 or 200,000 and more are living paycheck to paycheck. Now,
No.
a portion of that might be, poor spending habits, but also cost of food, energy, you know, dwelling has gone up exponentially. I mean, so I ran numbers, you ran the housing numbers, I ran numbers for car prices and energy. I was just curious on what that looked like. But from 1985 to 2024, Car prices have gone up around 64%
Hmm.
in that time period. Now, energy. So we're going to use a purchasing power equivalent of $100 in 1985, right? So $100 in 1985 would be equivalent to $608 today.
Hmm. Wow. Yeah.
So incredible. It's just an incredible jump, obviously, with inflationary numbers. We're all feeling it in our pockets. And while we think, numbers are going to continue trending in the right direction, core CPI and core PCE, which are higher than the headline numbers right now, are actually probably going to be bumpy till spring. And then obviously, as we move towards second half of the year, I think as the Fed starts talking about cutting rates, they already kind of started maybe June potentially. Again, I don't want to be super specific because we don't know. We don't have a crystal
Mhm.
ball, but we should get those cooling numbers and those rate cuts starting in the second half of the year if numbers continue to trend the right way.
Yeah. So what's the answer? I mean, it's not, it sounds doom and gloom, right? But it's all part of it. So I think that's, I think we'll be higher for longer. We've talked about that here, and a lot of people thought that we're going to cut rates. Cutting rates would be fantastic. And, obviously, because, you know, um, you can refinance, and that's part of the reason why housing hasn't changed, because people are just sitting on very low interest loans. Why would they come in now at 7%, right? And so, yeah, I
Mm-hmm.
mean, so those are things. So lower rates would definitely help. um, but I wouldn't mind, in some ways, to that, we can't go so crazy on low interest rates that there's a balance in there. I think I don't
Yeah.
know. I'm just rambling here, but I think there's a balance in there of where the right interest rates are to kind of slow this thing down. I think our leadership, it's an election year this year. Leadership is critically important. We got
Yep.
to get our fiscal house in order.
Yeah.
It's we can't continue to go down this type of path, and there's some pain to that. I mean, any of us have to, if we're spending more than we're making, at some point you gotta come to grips with reality and start to really cut back on some things. So our government needs to do that. It's silly what's going on, and so this is a good, So hopefully we get some better leaders, some better decisions in there. That Yeah, so that's going to be really important. So anyway, uh, interesting numbers. It was interesting to see that, and again, I think today we just wanted to bring some reality to the point that what the numbers are using, CPI versus PCE, all good, but in the real world, a lot of other things factor into how people are feeling about
Yeah.
where inflation is right now. So
Yep. So regardless, CPI, PCE, in reality, it might not be what you feel in your pocket. So didn't have a word to rhyme there, but
that's a good try.
we'll leave it up to you. But PCE, honestly, things are trending in the right direction.
Yeah.
It's looking good. So when rates start cutting again, you got that cash, extend duration a little bit if you can, if you don't need the money in that fixed income field, right? We've been preaching
Yeah.
it for a while.
Yeah. For real.
All right.
All right,
Well,
man.
we'll see you next week. Thanks so much for watching and listening to the closing bell. We appreciate you all. Until next time.
Take care.